Okay, let's start. So this is for week 2, Tuesday class. So remember last time we talked about basically two things. The first is we talk about buying on margin and short sale, and we did two practices. I hope you could try to solve those two problems yourself, right? Because potentially they could appear in your middle term. And then we started this dividend discount model. As I said, this is this section is really not hard because you guys should have studied dividend discount model in corporate finance one. So we basically started. So we basically started from this very general version of dividend discount model. You basically discount all future dividends. Um, K here is this discount factor, and specifically, K is solved by CAPM, and K is also called market capitalization rate or market cap rate. And then, based on this assumption that dividend grows at a constant rate of G, we discussed this constant growth dividend discount model. So let's today continue to dig deeper into this dividend discount model. Today, let's talk about investment opportunities. So, basically, you can imagine that if a firm has high growth potential, then potentially this this high growth should be factored into its stock price. So basically, this implies investment opportunities should affect a firm's stock price. To understand this, so let's first define dividend payout ratio. It's basically defined as the fraction of earnings paid out as dividends. And a related concept is plowback ratio or earnings retention ratio. That is, the fraction of earnings reinvested in the new project. So obviously, dividend payout ratio and the plowback ratio, if you add up them together, you should get 100%. So let's say you have some earnings. Let's say you have $10 of earnings. Right? Let's say you have, earnings of $10. Now let's say you pay out dividend of $4. And then the other $6, you would use the other $6 to make new investment. So you would invest $6 into your firm's new projects. So here, dividend payout ratio is 4 divided by 10, right? So the dividend payout ratio is 40%. And plowback ratio is plowback ratio is 60%, which is 6 divided by 10. So obviously, 40% plus 60% gives you 100%. Now, after introducing this plowback ratio, we could give you a formula about how to calculate the growth rate of the dividend. Remember that if you want to calculate a stock's intrinsic value, you have to know this G here, right? This constant growth rate. So how do you estimate G? You can see that this formula tells you that the growth rate equals return on equity times the plowback ratio. So ROE, which is return on equity, is defined as net income divided by shareholders' equity. So here, basically the equity refers to shareholders' equity. So it is not the market value of equity. Basically, shareholders' equity is the book value of equity, right? You could get net income, which is the bottom line, from the income statement. And then you could get shareholders' equity from the balance sheet. Remember, in your accounting course, you have asset here, you have liability, you have liability here, and this corner gives you shareholders' equity, which is asset minus liability. So here B is basically the plowback ratio, or you could say B is 1 minus dividend payout ratio. Well, we know that dividend payout ratio plus plowback ratio gives you 1%, gives you 100%. You also have this optional proof here. It tells you why the growth rate equals return on equity times plowback ratio. So if you have time, you could read this. But of course, this proof is not required. Now, let's think about how this plowback ratio B should affect stock price. So let's first start with this dividend discount model, and let's first think how the plowback ratio would affect your dividend payout and the growth rate. So as I said, we start from the dividend discount model. So let's say we know a stock's intrinsic value equals dividend divided K minus G. So let's express this formula in the form of the dividend, in the form of the plowback ratio. Right? So G equals ROE times B. Again, B refers to the plowback ratio. Now, D1, which is the dividend in the next period, equals earnings times 1 minus B. Right? Well, because B is the plowback ratio, so 1 minus B gives you the dividend payout ratio. So dividend payout ratio times earnings gives you dividend, right? So that's why D1 equals E1 times 1 minus B. Now, let's see how dividend and growth rate will be affected if we change plowback ratio B. Let's say we wanted to increase B. What can you see here? Well, obviously, as you increase B, you can see that D1 will decrease and G will increase, right? Now, let's say we do the opposite. We decrease plowback ratio. Now, according to this formula, right, you can see that D1 will increase. However, you can see that G will suffer, so G will decrease. Basically, this tells you that there is a trade-off. It says that, let's say we focus on the first line, right? Let's say if you increase this plowback ratio, that is, if you invest more, you will have a higher growth rate, right? Your G will be higher. However, your dividend, your initial dividend will suffer. Your D1 will be lower, right? This second row basically says that if you reduce your plowback ratio, that is, if you pay more dividend, then obviously your initial dividend will be higher. However, your long-term growth will suffer, right? So that's the trade-off. Now, let's go back to the stock price part. So we want to understand how changing plowback ratio will affect stock price. And you can see that based on what we have discussed here, right? Based on what we have discussed here, it is unclear how changing B will affect the intrinsic value, because you can see here, let's say if you increase B, right? If you increase B, what you can see here is the numerator will decrease. And you can also see that the denominator will decrease. So you really don't know how P0 will change, right? Well, let's think about the other case. So if you decrease the plowback ratio, now the numerator will increase. However, the denominator will also increase. So again, you don't know how P0 will change. So basically, you can see that this simple discussion does not give us clear idea how stock price will change with respect to B, right? So now let me directly give you the answer. So basically, a firm's stock price will increase in plowback ratio B if and only if return on equity is larger than market capitalization rate, right? If you know some partial derivatives, it's very easy to prove this. If you're interested, you could ask me. We could discuss this during office hour, but now I just want to give you the result. So if you look at this result, it's actually fairly intuitive, right? This result basically says that as long as your return on equity is larger than your cost of capital, then your stock price will increase if you invest more, right? This does make sense because you can see that if return on equity is larger than K, this implies that your new investment projects, they have positive NPV, right? They're positive NPV projects. Obviously, if you have positive NPV projects and if you invest more into these positive NPV projects, then your firm's value, your stock's value should increase, right? So it's a very natural result. Another implication from this result is growth. Growth itself is not valuable, right? Growth is only valuable if growth results in positive NPV projects. What does this mean, or how do you get this result? Well, you can see that from our discussion here, right? Stock price will increase in B if ROE is larger than K. This implies that stock price will decrease in B if ROE is smaller than K, right? This basically means that if your projects are negative NPV projects, you could still increase your firm's growth rate by increasing this plowback ratio. However, that will actually reduce your firm's value. It will reduce your stock's value. Okay. A different way to think about this is a stock's price could be decomposed into two parts. The first part is no growth value. The second part is growth value. To be more specific, no growth value. How do you calculate a stock's value if there is no growth? Well, you just set G equals 0, right? And if growth is 0, it means the firm is not investing in new projects, which implies that the firm will pay out all of its earnings as dividends. So you can see that the next period dividend, D1, equals E1, which is the next period earnings. So you can see that no growth value is given by E1 divided by K. Again, let me repeat. This no growth value comes from the dividend discount model, right? Because we are thinking about the no growth case, so G should just disappear. And also because we are talking about the no growth case, then there is no new investment. So earnings will be paid out as dividend, right? So D1 equals E1. This implies E1 divided by K gives us the no growth value per share. And then the second component is the present value of growth opportunities. Generally, we will actually use this formula to find out the PV goal, right? According to this formula, we can see that PV goal equals stock price minus this no growth value. Okay, now let's see this example here. So Takeover Target is run by Intrinsic management that insists on reinvesting 60% of its earnings in projects that provide a ROE of 10%, despite the fact that the firm's capped rate is K equals 15%. The firm's year-end dividend will be $2 per share, paid out of earnings of $5 per share. So, we basically have three questions. That's from the first one. At what price will the stock sell? Well, this is easy. This is just a application of the dividend discount model, right? So let's see what numbers do we have here. Okay, first we start from the formula, right? P0 equals T1 divided by K minus G. Now, obviously, we have K here. And we have D1, which is this guy here. But we don't have G here, right? So we would express G as ROE times B. Now, what is ROE? Okay, it's 10%. What is B? Remember, B is plowback ratio, right? It is defined by reinvested amount. It is defined by reinvested amount divided by earnings. So the firm pays out $2 as dividend, and the earnings are $5. So you can see that the firm will reinvest $3, which means the plowback ratio is given by 3 divided by 5, right? So we have D1, which is 2, and K is 15%, minus 10%, times 3 divided by 5. So this gives us, so this is 15% minus, I guess, minus 6%. So 2 divided by 9%. This gives us 22.22. Okay, let's see the second question. What is the present value of growth opportunities? So this one asks about PV goal, right? We know PV goal equals, so we're using this formula here. Equals the firm's intrinsic value minus this no growth value. P0 is given by 22.22. Now let's see what is the no growth value here. So E1 is given by 5. K is given by 15%. So this gives us minus 11.11. So you can see that the present value of the so-called growth opportunities is actually negative, right? And you can see that it should be negative because this project only provides an ROE of 10%. However, this cost of capital here is actually 15%. So it's a negative NPV project. Now this leads us to the third problem. It says, why would such a firm be a takeover target for another firm? Well, first, what is a takeover? Well, generally, if a firm is taken over by a different firm, then generally this takeover target will undergo some changes. For example, potentially some inefficient management will be removed, some redundancies will be cut. So in this case, you can see that this firm could be a takeover target because its management is investing in inefficient project, right? To be more specific, you can see that if this takeover target gets taken over by a different firm, then this different firm can actually remove the management. And at the same time, these negative NPV project can be just stopped, right? They could just give up these negative NPV projects. A very simple way to increase the takeover target firm's stock price is to stop investing in these projects. That is, this takeover target just pay out all its earnings as dividends. In this case, you can see that the firm's stock price would be earnings divided by K, which is 33.33, right? So this is basically the no growth value. Okay, now let's talk about multi-stage dividend discount model. So you can see that the constant growth dividend discount model is intuitive and it is very simple, easy to apply here. But you can see that under this this beauty of simplicity, you can see that it's not really realistic, because you have to maintain the assumption that a firm's growth rate is constant. In reality, you can see that this is almost not possible, right? If you think about a firm's life cycle, that is, how a firm grows from a young firm to a very mature firm. You can imagine that when this firm was a young firm, its dividend payout will be low and its growth rate would be quite high. And as this firm matures, right, you would observe that generally its dividend payment will increase. And you will also see that its growth will actually become lower. So this tells us we basically need a multiple stage version of this dividend discount model to account for the possibility that a firm could have different growth rates at different stages. So let's learn about this multiple stage model with a example. So let's say we want to value General Electric's stock, and we finish this first step. That is, we have forecasted GE's dividends, right? So here you can see that we have forecasted 4 years dividends. And we also assume dividend growth rate would level off in 2020. That is, after 2020, that is from 2020, the firm's dividend will grow at a constant rate. And here we assume the dividend payout ratio is 53% and ROE is 19.5%. And we also have G's beta is 1.1, risk-free rate is 2.5%, and the market risk premium is 8%. The question is, what is G's intrinsic value? So first let's first calculate the market capitalization rate, because basically this piece of information basically tells you, hey, you should use CAPM to calculate K here, right? Let's start with K. So K equals our F plus beta, and market risk premium, right? So RF is 2.5%, beta is 1.1 times 8%. So this guy here, which is called market risk premium, is 8%. So this gives us 11.3%. So if you have not learned about CAPM, I guess for now you could just memorize this formula, because in fact in the future we will actually cover CAPM in this class. So you're safe if you now want to save some time. So what you need to do is just to memorize this formula. Okay, next let me draw out the timeline and see how could we calculate GE's intrinsic value in 2016. So we have multiple years, right? So let's see, it's 2017, 2018, 2019, 2020, 2020, 2001, and the future to infinity. Okay, you can see here we have GE's dividends, right? So 2017 we have 1.04, 1.22, 1.41, 1.60. Now let's first calculate this guy here, P2020. That is GE stock's intrinsic value in year 2020, right? Why do you want to do this calculation here? Well, because according to the dividend discount model, the price in 2016 equals discounted discounted cash flow in 2017. Oops. I should use the market capitalization rate, which is K, which is this guy here, plus K. And 0.22, 1 plus K squared, plus 41, 1 plus K cube, 1.60, 1 plus K, with a exponential 4 here. And we're missing one thing here, that is P2020, right? So basically we're discounting 4 dividends at the end of period value, P2020. And by discounting these 5 numbers, we could find out what is the intrinsic value in 2016. Now, the question obviously is about how do we find out this guy here, right? Well, this is actually pretty easy, because we know that the growth rate would level off in 2020. So this basically means to calculate P2020, we could use this constant growth dividend model. So you can see that for all these periods after 2020, we could use constant growth model, right? So let's calculate P2020. So we should use D2021 divided by K minus G. Now, K is 11.3%. What is G? Well, G is ROE times B, which is the plowback ratio. What is ROE here? Well, ROE is 19.5%. So it's 19.5%. What is plowback ratio? Well, we have this dividend payout ratio of 53% here. And we know that, right? We know that plowback ratio equals 1 minus dividend payout ratio. So basically the plowback ratio is 47%. Okay. So what is this G here? Let me see if I could find. Okay, so G is 9.17%, right? So it is 9.17%. And what is D 2021? Well, it equals dividend in 2020 times 1 plus G, right? And we know that dividend in 2020 is 1.60. What is G? Well, we have calculated G equals 9.17%, right? Now you can see that we got all the numbers we need. So this gives us the price of G in 2020 is 75.83, right? Now, if we plug this number back into this formula, we could find out 21.6 is 53.40. Well, one interesting result is you can see that under this model, G's price in 2020 is $75.83. And you can see that, well, if you actually look at today's GE's stock price, okay, let me check. It's so actual 2020 price is $5.95, right? So there is a huge difference here. Obviously, I have not checked with these numbers, but you can imagine that potentially, maybe this ROE here is way too high, right? Or maybe the dividend here is way too high. I don't know. I mean, it's interesting to examine these numbers. Then you could see why you could get a very high number here, but in reality, today GE's price is only 5.95. Okay, now let's talk about free cash flow valuation model. So what's the major motivation to talk about free cash flow valuation models? Well, if you think about the dividend discount model, the premise of using that model is you have dividends, right? But you can imagine that in reality, a lot of firms are not paying dividend, especially for young, high-growth firms. There's just no dividends for you to plug in to this dividend discount model. So under these cases, how could we value a firm's value? More specifically, how do we value this firm's stock's value? Well, we could basically use this free cash flow valuation method. There are basically two methods. The first one is you would start from the firm value, and after getting this firm's value, you will subtract the value of debt. Then this leaves you the value of equity. In the second approach, you will directly find out the value of the equity. So in the first approach, because you're thinking about how to calculate the value of the firm, so essentially you would use free cash flow for the firm, FCFF. Basically, if you use free cash flow for the firm, then you will obtain the value of the firm. In the second approach, you would use free cash flow to equity. So you can imagine that in this case, if you're using free cash flow to equity, you will obtain the value of equity. So let's see how these two approaches works. The first approach is, let me repeat, you will start with the free cash flow to the firm, and then you will discount the free cash flow to the firm by the weighted average cost of capital. And this will give you the value of the firm. And after getting the value of the firm, you will subtract the value of the firm's debt. So this will give you the value of the firm's equity, right? Okay. Obviously, you have to know how to calculate free cash flow, right? So how to calculate free cash flow. So basically, you can see that this formula tells you that free cash flow is equal to the after-tax EBIT plus depreciation minus capital expenditure minus the increase in the net working capital. Again, you have to have some basic understanding in financial statements, right? You have to know what is this depreciation and what is this EBIT, what is capital expenditure, what is net working capital. Obviously, this is not a accounting course. It's not a corporate finance course. So I will ask you guys, if you have any difficulty in understanding these terms, then you should consult the appropriate material, right? As a finance professor, I would say that if you have finished corporate finance 1 and 2, then you should have no problem in understanding these terms. So basically, free cash flow to the firm represents the total cash available to both bondholders and stockholders. So after discounting free cash flow to the firm using weighted average cost of capital, this will give you the total firm value. And that's why by subtracting the value of debt, this will give you the value of equity. Okay, I think I should briefly talk about how to calculate WACC, right? So you can see that the formula here, right? So you're discounting this free cash flow to the firm with WACC. WACC is the short term for weighted average cost of capital. And again, this is a major topic in corporate finance too, right? How do you use the equity cost of capital and the debt cost of capital to calculate the weighted average cost of capital? Again, if you forget how to calculate WACC, then you should really consult your textbook or your lecture notes. So here, let me briefly talk about how to use this FCFF approach to find out the value of the equity. Now, let's say we first think about the timeline, right? So let's call this the first period, t equals 1. Of course, we have t equals 2 and dot, and t equals t. And let's assume starting from period t, we have constant growth. So you can see that here we're actually dealing with this multiple stage discount model. So it's sort of similar to this GE stock valuation example. And here you can see that I would want to calculate the firm's value. So I will start here to calculate VT, that is the firm's value at period T. So it equals to FCF T plus 1 divided by WACC minus T. You can see that this looks very similar to the dividend discount model, right? Remember the dividend in the dividend discount model for the numerator, you would actually use dt plus 1. That is the dividend payout in T plus 1 period. And then in the denominator, you would use K, which is the market capitalization rate or the cost of equity. And here, because we're valuing this firm's value, so we would use different terms, right? So here we are using the free cash flow to the firm in the numerator, and we are using this WACC in the denominator. Now, after getting this VT, we could discount this per period FCFT, right? So we could basically discount FCF1, FCFF2, and FCFFT, right? So we could basically discount these free cash flows and this last period value to get the firm's value, right? So that's how you get this formula. And this basically gives us V0, right? That is firm's value at or today's firm's value. And how do you get the value of the equity? Well, we talk about this, right? So you would want to use the value of the firm minus the value of debt. This gives you the value of equity. Okay, let's see. Oops. Let's see the second way, right? So in the second case, you would directly value this firm's equity. So you would use free cash flow to equity, right? How do you get free cash flow to equity? Well, you would use free cash flow to the firm minus the after-tax interest plus the increase in debt. I could briefly talk why this gives you free cash flow to equity holders, right? So basically the free cash flow to the firm implies or gives you the cash flow to both equity holders and debt holders. Now you would minus this interest rate, right? Remember that interest payment is essentially the payoff or the payout to debt holders. So if you use FCFF minus interest, this almost gives you the cash flow to equity holders, right? And then you would consider the increase in debt, right? Whenever this firm is increasing in debt, it means there's more cash flow or there's higher cash flow to equity holders. So if there is an increase in debt, then free cash flow to equity holders should be larger. Right? You would want to use this after-tax interest here because you have to think about the interest-tax shield. Again, if you have learned about corporate finance, you should have no difficulty in understanding this. However, if you have any difficulty, I would just recommend you to memorize this formula, right? Just remember, how do you convert from free cash flow to the firm to free cash flow to equity holders? Okay, now in this case, you can see that we could basically directly get the value for this equity. Again, we're having a two-stage model, right? So the timeline, again, is quite similar. We have t equals 1 and we have t equals 2. And last period, t equals the capital T. And then after capital T, we have this constant growth, right? We have this constant growth G. And then in the similar spirit, we would want to find ET, that is the value of the equity on date capital T. So this gives us FCFE T plus 1 divided by the cost of equity minus the growth rate, right? And again, we would look at each period FCF, right? FCFE1, FCFE2, and FCFET. And then we would discount these free cash flow to equity holders and the end of period value, right? And then discounting these cash flows and the end of period value, we would get this intrinsic value of equity. Okay, now let's think about the third approach of valuing equity. Remember that the first approach is about dividend discount model. The second approach, which is quite similar to the first approach, is about discounting free cash flows. The motivation you have model 1 and model 2 is if you have dividend or if the firm is paying out dividend, then you could use the dividend discount model to value this firm's equity. However, a lot of firms, they're not paying dividend. In this case, right, you would want to use the free cash flow model to calculate this firm's equity. Can you think about a firm which does not pay dividend to its shareholders? I would say most likely it should be a very young firm, right? So I don't know. Maybe you could check Tesla, right? Tesla is a young firm. I think it's about 5 or 6 years old. I guess most likely Tesla never paid dividends, right? So in the case of valuing Tesla, maybe it's a much better idea to use this free cash flow approach. Okay, now let's look at valuation ratios. For a lot of retail investors, most of the time, maybe they don't know dividend discount model or free cash flow discount model. However, if they have invested for, let's say, 10 years, if they have invested for a long time, most likely they would know some valuation ratios, right? So why valuation ratios is so popular? Well, because it's really simple, right? It gives you a very rough idea whether this firm is valued. It gives you a very rough idea whether this firm is overvalued or undervalued without dealing with growth rate, the estimation of the cost of capital, and the estimation of future dividends, right? So it's a very simple process. Okay, now let's see a example taken from the textbook. So let's say we are looking at a firm. Let's say this is the King Ross Gold firm. I don't know whether this is a actual firm or a fictional one. So let's say as a investor, you want to think about investing in this firm. So you're thinking about several valuation ratios. So here we are looking at these ratios. Of course, you have a lot of other data. For example, you have this profitability measures here, right? You have these income and earnings measures here. So this part is our focus because this part is about the valuation ratios. So for example, this one is the PE ratio, right? So stock price divided by earnings per share. And then we have this the PB ratio, which is price divided by the book value of equity, right? And then price divided by sales. This is easy. Stock price divided by sales. Then price divided by cash flow. So essentially, it's just price divided by certain type of cash flow, right? It could be operating cash flow or it could be free cash flow. Now we have this PEG ratio. So PEG ratio is, so here P represents price, E represents earnings, G represents growth. So it's basically price divided by earnings divided by growth rate. Right? Of course, later I will exactly define these ratios. I will tell you how to calculate them. So now let's just first get a initial taste how these ratio could work. So let's say you're looking at PE ratio, right? This Kinross gives you this 10.4 number. And you want to know whether this firm is overvalued or undervalued. So you compare this PE ratio with industry average. Right? You can see that industry average is actually about 80% higher compared with Kinross's PE ratio. So it seems like this Kinross is undervalued. Remember that generally lower PE ratio means undervalued. But you might be wrong because later you will see that whether a firm is undervalued or overvalued depends on its growth rate. And PE ratio does not give you growth rate. And now let's say we're also thinking about PS ratio, price sales ratio. So Kinross's PS ratio is 1.5 and industry average is 4.34. So here you can see that Kinross actually has a much lower PS ratio compared with industry average. So again, it seems that PS ratio also suggests that this firm is undervalued. But again, PS ratio does gives you this firm's growth potential. So now we look at PEG ratio, right? So what is PEG ratio? Again, PEG ratio, right, equals PE ratio divided by growth rate. And here you can see that the PEG ratio is about 2 and industry average is about 1. Generally, you would want a low PEG ratio, right? Lower the better, because you can see that G is in this denominator. So a low PEG ratio basically means that you're paying small money for higher growth rate. However, here you can see that its PEG ratio is actually above 2. It's much larger compared with industry average. So this PEG ratio gives you the idea that, well, maybe this Kinross firm is not undervalued. It looks like it's undervalued, but below this surface, you can see that this firm is potentially suffering from extremely slow growth, right? So this firm potentially has no growth potential. That's why its PE ratio is very low. That's why its PS ratio is very low, because it does not have a good future, right? So in this case, even with low PE ratio and low PS ratio, you might still think this firm is not a good investment. So what kind of lessons you can get from this example? I guess there are at least 3 lessons you can think you can have here. The first one is valuation ratios are very easy, right? You can see that you just, let's say for example for this PE ratio, right? You just need 2 numbers, stock price and earnings. And after getting these 2 numbers, you can have your ratio. So it's really easy and it's intuitive and it's also powerful. And the second lesson is it's probably better to look at multiple valuation ratios, right? Remember that if you only look at PE ratio and PS ratio, then you would get the idea that this firm is undervalued. But if you factor in growth rate, if you think about the PEG ratio, it would tell you that this firm is not really undervalued. It looks like it's undervalued because its growth rate is very small. Third, it's important to compare a firm's a firm's valuation ratio with industry peers or with industry average. So that's why we compare Kinross's P/E ratio with the industry average. That's why we always compare the firm's number with its industry average. Well, the reason is obvious because different industries can have different average P/E ratio. So if you compare a firm in food, if you compare the P/E ratio of a firm from the food industry with the P/E ratio of a firm from the high-tech industry, then you're making a mistake. It does not make sense at all, right? So it's important to keep this in mind. Okay, now let's start with the most famous ratio, that is the price-earnings ratio. So basically, the P/E ratio is calculated as price per share, that is the stock price, divided by earnings per share. So how do you get earnings per share? So it's basically earnings, that is net income, divided by number of shares. Right? That's how you get earnings per share. We can show that P/E ratio is actually related to PV goal. Can you still remember what is this PV goal thing? Well, we learned about this PV goal here. Oops, where is this PV goal? We learned about that the stock's intrinsic value can be decomposed into two components, right? So the no growth value and the present value of the growth opportunities. So now let's see how could we find out PE by using this formula. Okay, let me go back to this PE ratio section. Okay, so we learned P0 equals E1 plus K plus PV go. So this implies P0 divided by 1 equals K plus PV go divided by E1. And this equals 1 divided by K, 1 plus PV go, E1 divided by K. So that's how you get this relationship. This is a mildly interesting formula. It basically tells you that a stock's P/E ratio, right, is determined by the ratio of PV goal versus the no growth value, right? What is PV goal? It's essentially the value from growth opportunities. So you can see that if a firm's future growth opportunities is much larger compared with the no growth value of the firm, then this firm will have a high PE ratio. Essentially, this tells you high growth firm will have high PE ratio, right? Now we could also look at this from the perspective of this dividend discount model. So we know P0 equals D1 times K minus G. And D1 equals E1 times 1 minus plowback ratio. So K minus G, G is ROE times plowback ratio, right? And this implies PE ratio is 1 minus B, K minus ROE times B. Why important notice here is when you're calculating PE ratio, you're using P0 divided by E1, right? So you're using today's stock price, and then you divide today's stock price by tomorrow's earnings, right? This gives you the PE ratio. At least in this textbook, we tend to define PE ratio like this. But in reality, when you're actually investing, This is called forward PE ratio. Right, forward PE ratio. You could actually use P0 divided by E0. That is today's stock price divided by most recent reported earnings. In this case, you could call this as trailing PE ratio. But in this textbook, we will use the convention that we would always calculate forward PE ratio. Okay, now let me remove the proof here. Now, this is an interesting formula because you can get a lot of results from this simple formula, right? So let's see when a firm's stock will have a high PE, right? First, if its return on equity increases, you can see that if ROE increases, right? If this guy increases, then the denominator will be smaller, which implies PE ratio will be higher, right? Then we also have this. So, if ROE is larger than K, then increase in plowback ratio will increase the firm's PE. We have learned about this because we have made the claim, that is, if ROE is larger than K, then a firm's stock price will increases in the plowback ratio, right? So here you can see that in this case, you will get the fact that PE ratio will increase if you increase the plowback ratio under the assumption that ROE is larger than K. So in this case, when ROE is smaller than K, then basically you can see that the investment projects are negative NPV projects. So if the firm decreases plowback ratio, then the firm is wasting less money into negative NPV projects. So the firm's stock price should increase, which means PE ratio should increase. Now, the last result, we can show that if the firm's K, that is, if the firm's market cap rate increases, then you can see that the denominator will increase. Let me restart. So the fourth point says that if the firm's market cap rate K decreases, then denominator will decrease. This implies that P ratio will be higher, right? Okay, let me summarize. So basically you can see that these four results tells us the following things. Okay? The first result basically says that if a firm's investment project has higher return, then its PE ratio should be higher. The second one says that if the firm is investing more money into efficient projects, then the firm's PE ratio should increase. The third result says if the firm is investing less money into inefficient negative NPV projects, then the firm's PE ratio should increase. And then the fourth result says that if a firm's risk is lower, then it should have higher PE ratios. Okay, now let's think about the drawback of PE ratio. So you can see that okay, so according to dividend discount model, right, you can see that as G increases, P increases. This implies that as G increases, P ratio will increase, right? So basically, it tells you that if a firm has high PE ratio, then it could be due to two reasons. First, it's truly overvalued. Second, it is not overvalued. It has high PE ratio because it has high growth potential, right? If you're having these two situations, then you can imagine your investment strategy should be different under these two cases, right? For the first case, if the firm is truly overvalued, maybe you want to sell, you want to empty your position, right? But if it's the second case, you will be more careful, right? Even this firm has a high P ratio, but if this firm is, or you're expecting this firm to experience exponential growth in the future, then maybe you want to invest in this high PE ratio firm. This is pretty obvious if you actually invest. If you compare two kinds of firms, if you compare a utility firm versus a high-tech firm, right? If you look at a utility firm, its PE ratio is generally very low. And if you look at a high-tech firm, let's say if you look at Google or Amazon, I believe its PE ratio is should be at the range of 30 to 50. And if you look at Tesla, I don't know the exact number. It has to be above 100. So basically, Google has much higher PE ratio compared with a utility firm. But still, Google could be a valuable investment because it has this much higher growth potential compared with a utility firm. Right? So based on this, that's why there is this PEG ratio, right? It's really this PE divided by G, right? G refers to this guy here. So it's the PE ratio divided by the growth rate. Generally, you want PEG ratio to be small, right? Because you can see that PEG equals PE divided by G. So you can see that if PEG is smaller, holding PE constant, you can see that G is larger. So you're basically getting higher growth potential from your investment. Okay, now let's look at this example here. It says ABC stock has an expected ROE of 12% every year. Expected earnings per share is $2, and expected dividends is $1.5 per share. Its market cap rate is 10% per year. The first question asks its expected growth rate, its price, and its PE ratio. So we start from G, right? Well, we have learned G equals ROE times plowback ratio. So ROE is 12%. So what's the plowback ratio here? Earnings per share is $2, and dividends are 1.5. This implies the firm would invest 50 cents into new projects. So the plowback ratio is 0.5 divided by 2. This gives us, I think, 3%? Yes, this gives us 3%. Now its price. So we would use the dividend discount model. So P0 equals D1 divided by K minus G. What is D1? It's 1.5. What is K? 10% minus 7%. So this gives us, the G is not 7%. G is actually 3%. So I think it's 20 something. So it gives us 21.43. Now what's its PE ratio, right? So PE ratio equals P0 divided by E1. Again, you want to use the next period earnings. So P0 is 21.34 divided by earnings. So it's 10 something, right? So it's 10.71. Okay, great. Let's look at B here. If the plowback ratio were 0.4, what would be the expected dividend per share, the growth rate, price, and the PE ratio? Well, it's almost essentially the same, right? Expect now we're having a different plowback ratio. So if the plowback ratio was 0.4, then this implies the dividend equals earnings times 1 minus the plowback ratio. So we have $2 of earnings times 0.6, it's 1.2. Now growth rate is ROE times growth times the plowback ratio. So ROE is 12% times B, which is 0.4. So it's 0.48%. Now we use the dividend discount model. And we have 1.2 divided by the same market cap rate minus 4.8%. This should be 23.08. What else? The last question. What's the PE ratio, right? So PE ratio equals price divided by earnings, which is 2. This gives us 11.54. Right? Okay. Okay. Let's see what other results we could get from this example. Okay, if you compare problem A and B, you can see that stock price in B is higher. PE ratio is also higher. So why do you get this result? Well, because you can see that the plowback ratio in problem B is 0.4, and the plowback ratio in problem A is 0.25. So you can see that plowback ratio in problem B is higher. And if you compare ROE and the market cap rate, you can see that the firm is investing efficiently, right? It is investing in positive NPV project. And we have learned about this. That is, if ROE is larger than K, then the firm's stock price should increase if the firm increases the plowback ratio, right? So that's why you get higher stock price and higher PE ratio in problem B here. We also have other valuation ratios. The first one is called PB ratio, right? So it's basically the ratio of stock price divided by the book value per share. Here, book value represents the shareholders' equity. Then we also have this price to cash flow ratio. So it's the ratio of price to a certain measure of cash flow. So you can see that you could use operating cash flow or even free cash flow. Why do you want to use price to cash flow ratio? Well, because earnings can be manipulated, right? The firm can just make some choice, such as its depreciation schedules. So this could affect earnings, right? However, cash flows, right, which tracks cash actually flowing into or out of the firm, is less affected by accounting decisions. This basically tells you that the measurement of cash flow is more accurate, right? So if you use price to cash flow ratio, you could potentially get a more accurate measure. This is also useful in when you're investing in some developing market, because sometimes in those markets, accounting numbers are actually not accurate. So in this case, you want to think whether cash flow will give you a more accurate result. Now, PS ratio, price to sales ratio, right? It's the ratio of stock price to the annual sales. Why do we use this? Well, it's because a lot of firms don't have earnings, right? If you're calculating PE ratio, the premise of doing that is you have to have earnings, right? When a firm does not have earnings, we could just use its sales. This is actually quite useful because for a lot of early stage high growth firms, in the first several years or in even the first 10 years, these high growth firms would just burn money, right? They would never turn or earn any profit. In this case, using PS ratio would give you a certain valuation metric to think about the value of this high growth firm. If you do some manipulation, you can see that the PB ratio and PE ratio are actually related. You could look through these steps. So I will not go through these steps. They're quite simple. In the end, you could find out this result, right? PE ratio equals PB ratio divided by return on equity. So this gives you the connection between PE ratio and PB ratio. And it also tells you that you need to make sure that you understand the difference between a good firm and a good investment. Sometimes you might think a good firm is always a good investment. This is not true because even if a firm is good, but if its stock price is too high, this firm will still become overvalued, right? And even if a firm is bad, it has low ROE, but if its price is low enough, in this case, its PE ratio will be low, and this firm could be undervalued. It could be potentially a buy for you. Right. Okay, sometimes you might wonder, oh, you have told us several valuation metrics. So which one should I use? I would say you should calculate all of these ratios we have just mentioned because it gives you a more comprehensive picture. And also you can see that empirically, right, the PE ratio, price cash flow ratio, and PS ratio, on average, they typically gives you this same result. Right? So most likely you will not get a lot of conflictions between these different ratios. Even if you get different answers from these different ratios, then this gives you a opportunity to think, why do you get different results? Why do you get different investment strategies? Because of different ratios, right? Okay, that's for today's class.